Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 9th of September. I'm Daniel Lam, your host for the podcast. This will be my last podcast until the 25th of September, as I will be representing Hong Kong, China at the Chess Olympiad in Budapest. In the meantime, my colleagues Steve Bryce, as well as Zhonglang Han, are going to bring you our latest thoughts in this Cut to the Chase podcast. Now back to the markets. Risky assets have been under pressure in the month of September, and this is mainly due to the concerns on global growth slowdown. So last Friday, the August non-farm payroll was below expectations. It was 142,000 workers of expansion, and expectations was 165,000. Payroll growth fell to a four-year low of 116,000 on a three-month moving average basis, and notably, the pro-cyclical manufacturing payrolls significantly surprised to the downside. Moreover, the past 2 months' payrolls were revised down by a total of 86,000. Now, the unemployment rate would be on an uptrend if we get payroll growth at lower than 170,000 per month, and that is considered as a break-even number for unemployment rate. Well, the revised payroll growth has now come short of this threshold for 4 out of the last 5 months. Now, this NFP number is consistent with the other recent major US macro releases, such as the ISM figures that we discussed in our podcast last week. Demand seems to be deteriorating and inventories are on the rise. Now, our base case remains that the US would achieve a soft landing. But this latest set of macro releases is going to lead to short-term pressure on risky assets. Now, since the pandemic, US growth has become a more important driver of growth for most economies. So, for example, if you use the OECD Trade in Value Added, TIVA, data and do simple regressions to get the beta of a country's growth against US GDP growth, you can see that many economies lower the dependence on the US from 2015 to 2020, but they have shown increasing correlation to US growth since the pandemic. So, we've turned more defensive in our recommendations. We are overweight gold, which works well in a weak US dollar and falling real interest rates environment. We have recently added US and European healthcare stocks as opportunistic ideas, because historically, the healthcare sector has delivered steady earnings compared to the rest of the markets. We also believe that long-dated treasuries, i.e. those with 20 years till maturity, would be a quality way to gain fixed income exposure. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.